Guys, I'll just take a moment to also mention here on behalf of Steph that, please treat all of this as general advice. If it's, specific circumstances, then you should either consult your own financial advisor or accountant, or maybe talk to Stefan individually so that he can cater to your personal circumstances, because obviously this is a very broad forum and we can't discuss everything in detail on personal matters. Is that correct, Steph?
You're a good man, Savid. You're a good man. And what I might ask you to do is, even after this, we'll shoot out an email to all the people on the line with the recording, and it'll have my financial services guide. So if you wanted to know any more about me, you can feel free to go through there. But yeah, as Savid said, all just general information.
Yep. Next one is, can I maintain both Superfund and SMSF? Reason is I don't wish to pay high premium on my insurances.
Yes, you can. Quite simply, if you've got, say, an industry fund, you've got insurances through. Now, a lot of clients might want to start a self-managed super fund, but they might have health issues. Therefore, they might not want to change over where their existing super fund is because they've got insurances there already. I get it. It's absolutely fine running 2 accumulation accounts. The only issue is people normally have high fees that they're paying. Therefore, they're paying 2 administration fees. They're paying 2 sets of accounts and everything like that. So it'd probably be for if you're running, if the reason for keeping an account is because of the cost of the insurances, it's really important to do a proper analysis to say, well, if I combine both fees and took up new insurances, where is it worth having my money?
Sure.
Yeah.
Next one, I have been advised that if I purchased a commercial property via SMSF, I'll need a legal certificate of advice. Can you explain what this is and how much does it generally cost?
So legal certificate of advice is probably referring to a statement of advice from a financial advisor. And the reason people normally require a financial advice or a statement of advice is because the banks rely on this and rely on the advisor to have done the stress test for the client in relation to super contributions, insurance premiums, and even money that might flow out to things like interest payments and maintenance bills and things like that. The reason you need it is because the banks will lend their hat on the advisor giving appropriate advice for the client to go and get the loan, which reared its head during the Royal Commission, where a lot of advisors got pulled up for not giving really direct advice. And so that's why it's become quite important. How much does it cost? Well, depends on your situation and circumstances, but it is costing a lot more because there's a lot more analysis that has to go into it. And so you're looking at anywhere between $4,000 and $5,000 for a statement of advice. Different people obviously charge different amounts, but there's a lot of work that goes into making sure they're right and appropriate. And therefore, that's got to be factored into any costs in setting up an SMSF for the purpose of buying a property. But hopefully that answered your question.
The next one is again a very specific question. So let's see if you can generalize the answer to that. So I'm 55 and my super is around 250K. Should I sell my only investment property now or in 3 years' time and deposit it into my super?
I hate to get specific. All that I'll start to talk about is, look, when you start to become older, it's really important to start to get some financial advice around what to do for your retirement, knowing, because you've got to factor in things like, what are your living expenses? When can you start to access your superannuation? What's your plans for working? When do you want to retire? How much do you want to retire off? So there's a whole lot of things that come into it. The main rules that people start to consider is, well, if I sell my property, what's going to be my tax implications of selling that property? Therefore, what kind of capital gains tax am I paying? If I am paying any sort of capital gains tax, how am I offsetting that? And should I be making extra super contributions? With the super contributions, how much can I make? Are they tax deductible and not tax deductible? Where we talk about concessional contributions versus non-concessional contributions. And when can I start to access my superannuation if I need to draw another income stream? That being, is it at 60? And do I need to have ceased work or retired? Or do I wait until I'm 65? And what's legislation going to say when I do hit 65? Do I need to then wait until I'm 67? So can I answer your question? No. But hopefully I've given some information around things to think about when you're getting towards that retirement age. And there's one reason that a lot of people don't like holding property as they enter retirement. And it's all about when you need access to money and you're not working and the only form of income you've got is from your super fund, well, what do you do when you need a lump sum of money, like $10,000 or $20,000? You can't sell a bathroom, you can't sell a kitchen, but maybe you can sell down some of your shares in order to fund whatever you need. So that's where people start to think about and you get the tax refund immediately because your PAYG tax decreases. So I had a client I presented to just today, believe it or not. We were salary sacrificing $500 a month, but out of his cash flow, he's only down $315, even though he was contributing $500 to super each month. And the reason being is because he doesn't have to pay the tax. That's already there. Member voluntary is you use your personal savings to then contribute to your super fund. Now you have to lodge what's called a notice of intent to claim, and then you have to come back at the end when you've done your tax return and tell the ATO, hey, I made an extra contribution to super. I paid a lot more tax personally that I shouldn't have. Can I please get that tax back? And they're the differences. Salary sacrifice comes out of your paycheck, PAYG gets taken off. Member voluntary contribution is you essentially make it out of your bank account and then claim it back at tax time.
Sure. Next one is there a minimum contribution that you need to make annually to an SMSF?
To an SMSF, to a super fund, no, there's not. If you are working, your employer would need to put in 10% of your wage now. It is now mandatory. There are no minimums, there are only maximums. So in terms of claim and tax deduction, the maximum you can put in is $27,500. You may be able to increase that depending on your prior year contributions. If you're putting in after-tax money, so you want it to go in as a tax-free contribution or a non-concessional, you can normally put in $110,000 without triggering any bring forward rules. Otherwise, if you really want to pump it up, you can pop in $330,000 as a non-concessional. And that triggers a bring forward rule, which restricts the amount you can contribute in the future. But again, whenever you're making extra contributions like that, it's really important to get the right advice to make sure you should do it, because once it's in there, guess what, Savid? You can't get it out
And take it out
until you're a bit older. So
yep.
Yeah, it's really important to make sure you understand all the rules.
Would you mind repeating the pros and cons of land banking invested through SMSF?
Yeah, so land banking is where you should really figure out. I think land banking is one of the areas you really need to get specific advice on. What's the site you're looking at? What's the site worth? Does it fit into the SIS legislation? And can I hold that kind of asset through my self-managed super fund? So it's really about getting specific advice on that topic. And it's important to realize while land banking is a great opportunity for a lot of people, doesn't always work out. And therefore, if it has not met your main goal and objective of growing your retirement balance, then it may not be the right strategy. But I'd say with that one, we've got a specific property in mind or asset. Really go and seek some advice just on that situation.
Next one is, many banks don't approve off-the-plan projects within SMSF. Then what's the way to go? Established or ready to move properties, or is there another way?
Yeah, there's been a lot of issues around off-the-plan properties, especially since the Royal Commission, where a lot of banks have stamped it out. Because what happens is if the valuation doesn't stack up to what it was purchased for, then you need to put in more money. And if your superannuation fund doesn't have the money and you personally can't make the extra contribution, then you can't settle the property. And then the banks, obviously, they don't get the loan. You can't settle the loan, so they've wasted a lot of time. Your deposit is lost. Whoever gave you the advice to set up that and to buy that property and you can't do it is in a lot of trouble as well. So therefore, you'll find that it's very difficult to get advice on buying off the plan properties nowadays, as well as it's very difficult to get lending for it. Therefore, what we see is established is the way to go. You need to keep in mind the amount of cash you've got in your fund. So generally work off, to be safe, 40%, 50% cash remaining in the fund, because really banks, advisors don't like people pushing the boundaries because, and I don't know if anyone on the line has heard about this or heard of a situation where someone has purchased an off-the-plan property through their self-managed super fund, couldn't settle, and therefore don't have the asset, but have lost a whole lot of money. I'm pretty sure that a lot of investors who have ever heard of lending through an SMSF, buying property through an SMSF, have heard of that situation, and no one wants that to happen anymore. Therefore, everyone, it's like walking on eggshells. And therefore, people just go, if you're going established, you know what the rental return is. Therefore, you can really project what the estimated rent should be. And around that, how much money do you require for a maintenance fund, for interest costs, if you're without rent for a specific period of time, just to ensure you can maintain the property and you don't have to forcibly sell it. So,
cool. Are there any governing rules for using equity from property bought under SMSF to buy other ones?
Yeah, so limited recourse, simply you can't use equity in properties to go and purchase other ones. And that's why banks will require a specific level of cash before they borrow you money. If you are going to, so it's all about the cash you've got in order to put towards a property in a self-managed super fund, and they've called limited, if you're going to borrow money, you need to set up a specific bear trust, and each property has to have its own bear trust, or each loan has to have its own bear trust. So if the increase in value in the property will only increase the value of your super fund, but it will not go towards equity or be able to be used as equity towards the next property purchase.
Unless you sell the property?
Or then you've got no equity in the property if you sell the property.
Yeah. But you know, then you've got that extra cash of it, right? That's the only way. That's
right. Yeah. So it's all about how much cash have you got to put towards that property. Yeah.
Okay. If I sell the property before I retire and buy another one later, do I have to pay CGT?
Or paying CGT when you sell property through a super fund, it all matters about what is your age and your situation at the time. Have you made it become an account-based pension? You can trigger an account-based pension before you actually formally retire by doing something called ceasing gainful employment. But you can't, in any situation, whether if you're selling a property in your personal name, you can't push a capital gain to a future year. So when you sell an asset, really assess what your tax liability will be in that year, given your situation, and if it's superannuation, given where your superannuation is at the time. Is it an accumulation phase? How long have you held the asset for? Therefore, if you do sell it, understand what your tax liability will be when you do sell it, when you do your tax return for the fund.
Sure. The next one is, if you have a property fully paid off, can we then use the equity to purchase another property? So I think I already answered that part. Actually, no, it's about a property fully paid off. So the equity question still remains the same, right? You can't use the equity. You have to sell that property, use the cash, and then buy another property. Correct?
Yeah, that's right. Whenever you're going to, in saying that, well, can you use equity in something you own 100% of? Then you need to go out and borrow money, and that's using the equity. And every time you go and borrow money, you need to have the cash for the deposit. So you're not going to be able to borrow 100% or 100% plus stamps and costs for a property through your super fund, because you need the physical cash. So the equity you've got in the asset doesn't matter.
Yeah. Can a property be bought using SMSF and a family trust?
You looked at that, Suvid.
Because I haven't heard of that before, so I don't know what to make of that question. Let's see what your thoughts are.
Yeah, so there's certain things called regulated unit trusts and unregulated unit trusts, where you can set up and purchase property in using multiple parties. So there's a certain section 13.22C, I believe it is, or that's a specific trust you can set up that allows you to combine funds both personally and through super. If you're going to use lending, though, it's very difficult and you probably won't be able to. So yes, you can. I believe so. The restrictions around it, though, really come back to the drafting of the unit trust deed. So you can't put two names on the title, have to be through a specific trust. And that's where you've got to get a really specific lawyer involved, an SMSF specialist lawyer, in order to draft that trust deed to ensure basically that you're abiding by the superannuation regulations when investing into the asset. And the reason there's so many rules around superannuation is because of the tax effectiveness of super. As I said before, 15%, 10%, 0%. They just want to make sure that everyone's doing all the right things. And therefore, you need to, if you're going to go do something quite tricky like that, really go and seek the right legal and financial advice.
Now you know why I had that expression, right?
Because obviously,
not many
people do it.
If you, I'm thinking of it from the lending side of things, how convoluted that would be, and how it would be a nightmare for the lenders to even try and get their head around it. So
yeah, good luck getting a loan for that.
Yeah, exactly. Okay. Next one. My question is on buying private company shares in Australia through SMSF. That is, are there any restrictions on using SMSF funds on buying shares in private companies that are not listed?
Yeah, so it's really important. So whenever you set up a self-managed super fund, there's a deed that's created, and the deed is essentially the governing rules of the super fund. So making sure it's quite specific as to what you can and can't invest into. And when it comes to actually using super fund monies to invest into private companies and things like that, it really looks at what's the control, what's your controlling portion of the private company. Look, super funds can do all kinds of tricky things. Like they can lend money to people that aren't related parties. Some of the restrictions include, is the person a related party? What's your ownership? They're probably two of the main ones that people tend to err on the side of caution with. So essentially, as long as the investment is for your retirement benefit and you see some sort of growth out of that investment, then there may be an opportunity to use those funds to buy shares in a private business, provided you jump through a heap of other loops. Two of the main ones including related party and the other one that I've just forgotten that I said before. Related party and control. You cannot control the asset or the company.
Sure. Next one is, can we buy overseas property using SMSF?
I've never done it. I'm not 100% sure on that answer. In terms of if you want to use debt, then I'd say probably not. If you're not, if there's no debt, I don't see why you could not, given you can buy overseas shares.
Overseas shares, exactly. So it would be very similar.
This would be somewhere to seek specific advice to make sure your trust deed's set up to allow you to do something like that. For me personally, I've never done it, so I can't give an exact answer for that. But really, if you're going to do something like that, I'd really be seeking out the right advice and really keeping in mind that any asset owned by a super fund can't be used for your own personal gain. It's got to be for your retirement benefit. So keeping those rules in mind, go and seek an advisor, and it may be possible.
Okay, so that's all for the questions I have on the board. If anyone has any other questions, please feel free to unmute yourselves, ask the question. In the in the meantime, I'll just have a discussion point with you, Steph. So how do you see different strategies applying to people who want to invest in residential properties versus commercial properties when it comes to self-managed super? Are they very different, and are there specific ages that, from experience, people look at doing those kind of things because of different yields, etc.?
Commercial properties typically have a higher buying price. Therefore, you've got a higher balance, and banks also want to see more cash go towards the purchase. For the simple fact that there's more likelihood that if you don't have a tenanted commercial asset, it's harder to rent it out. And therefore, you need to have the cash or the cash flow to pay for your mortgage costs for that property, for your loan costs. people who typically go for commercial assets are really looking for income, because with commercial assets, when you buy the asset, you buy it on a yield. So you buy it at a yield of 5% or 6%. When you buy for residential property, a lot of you would know that, well, the yield or the income return on a residential property isn't great. But the good thing about it is there's normally capital growth behind it, which is what everyone looks at and what everyone invests for. So they're the two kind of differences. Obviously, the purchase price for residential property is a lot smaller, therefore you can buy more. And the commercial asset, to get a good commercial asset through a super fund, it is quite a bit larger. You can get smaller, like a lot of factories and factoriettes that are around now. They're a smaller purchase price. Again, it's just making sure you've got the cash requirements there. And therefore, when you need more cash, you can't borrow as much. Therefore, you can't have as high of return on your investment or on your cash into the investment. They're the main two people.
You've sort of half answered what I was going to ask next, which was, when we talk about commercial, does that also include, industrial, warehouses, factories, those kind of places as well, or is it purely just a commercial shop front or retail space?
No. Commercial is that entire sector that's not residential house. I talk about commercial as your industrial and everything like that. And we owned our factory. Where was our factory? Deer Park. We owned a factory, Deer Park, had a really great rental return of about 8% a year. It was a no-brainer for us to own it through the super fund. And then we sold it for a good capital gain as well, because that market went pretty hot for a while. So, it's, you can buy anything, factories, whatever you want, as long as it fits the bill and you can get the loan for it, the bank approves it. There shouldn't, and your trust deed allows for it, shouldn't be much of an issue.
Sure. There's another question that's popped up, and I think it's more a me question than a you question. It's, do SMSFs offer offset accounts? The answer is yes. Some of the lenders do offer offset accounts in your SMSF loans. So that is definitely doable. Not all of them do it. And also keep in mind that, in fact, I got an inquiry today itself that most of the big brand name banks that you talk about don't do SMSFs anymore. So just keep that in mind as well. They're mostly a space that non-bank lenders now operate in. And yes, there are different kind of products where you can get your redraws and offsets and all those kind of things as well.
It's only a few different banks. So some of the still second tier lenders have only just started to come back. Is that right, Suvir?
Correct. And so the likes of Postbank, for example, have just returned back. Yeah.
And what are some of the rates we're seing now with lending?
The headline rates are in the 3s, but realistically, we're still talking about the 4s. Low 4s. But there are some lenders out there who are starting to talk about rates in the mid to high 3s.
Yeah, which makes it affordable and a decent strategy.
Yeah.
Whereas last year, probably wasn't the smartest move to be borrowing money at high rates.
Last year was more around the 5 to 6% range at least.
Yeah. Crazy.
There's another question. For a couple, both working, what are some of the popular tax saving methods?
So both if PAYG employee, it's very difficult to save on tax. The government's done a really great job of making sure that tax is paid properly. In terms of tax savings, where do you get tax deductions? If you pay for income protection out of your personal name, you get a tax deduction for that. If you make superannuation contributions that are deductible, called concessional contributions, we spoke about that briefly before, you can get a tax deduction for that. Suvir knows a lot about depreciation schedules and depreciation on property. So where you are a decent income earner and you buy a property, while it might be cash flow positive, if it's a newer property, they might have depreciation that comes through from that. And that depreciation allows you to claim back on some of the tax. For those of you that don't know what it means, essentially, if you earn $100,000 a year, for example, you have an investment property, it's new, it earns $20,000 a year in rent, all your outgoings are $20,000 a year, which means you're back down at $100,000. If you can claim $10,000 depreciation off that, and you're on a tax rate of 34.5%, then you get, call it $3,400 back from your tax bill, as a little example. So, those sort of properties. Otherwise, you can do things like use borrowed funds to go into a margin loan, prepay your interest. Prepaying interest is something a lot of people like to do. There's a few different strategies around, and a lot are around either debt, property, or superannuation.
The next question is, there are high LVRs on offer. Are these due to COVID, and do you see these decreasing?
David, this is you, my man.
I mean, look, the way I see it, it's not COVID or pre-COVID or post-COVID question. It's more a case of where the lender books are standing. It's a very simple thing. If a particular lender's book is filled up at a particular LVR, they start changing their rules around it because they are, again, because of what happened with the GFC and all of those things. Everyone's very conscious of having the right amount of debt exposure at different levels. So that's all that boils down to. That's why you'll see a lot of banks increasing or decreasing their retail rates also out of cycles, which has actually started happening of late. So if you guys remember, somewhere around February, March this year, a lot of the banks reduced their 4-year fixed rates to all-time lows, which had never been the case. The 4-year rates being the lowest out of all the rates, and that was very specifically to fill up a certain part of their books. As soon as that got filled up, those were the rates that shot back up again, and again the 2-year rates became the cheapest ones. So that will keep happening from time to time.
Yeah, good.
What is prepaying interest? Again, a tax-effective question, I guess.
Yeah, well, so prepaying interest is essentially where you pay your interest at the start of a loan or a specific time at a loan. For example, it might be June. You might have some free cash flow. For the next 12 months, you're going to pay $20,000 in interest. So therefore, you go, well, I'm going to pay my interest now. Get the bank's approval. And therefore, you pay that $20,000. You claim it in June, and then you claim it back at your tax return in July. So at least you can get that tax back for the interest that you paid. Say that your asset has been negatively geared for that period, but it's important to remember that in the next year you're not going to have that interest that you can claim unless you prepay it again.
Yep.
So it's a great strategy for 1 year. So you might have like a tax effect or a tax implication in the one financial year, trying to do everything you can to bring that tax down. It may work, but yeah, it's essentially bringing forward your 6 months, 12 months of interest that you're going to pay and paying it in one lump sum in a specific amount or specific date, generally just before the end of the financial year.
And I'll just add on there, the reason why Steph said, with your bank's approval is because, remember, just like, we are trying to save tax, the bank will also try to understand what you're trying to do, because if you are prepaying and claiming that you're having higher income this year, in a way you're saying you're expecting your income to become lower the next year, which means automatically the credit assessor's question would be, that means there's going to be a substantial change in the circumstances. How are you going to be able to service the loan long term? So you just have to be very careful with that kind of strategy. It is a good strategy, but at the same time, most of the time we see people do that when they expect, someone going on a maternity leave or going on a holiday or something like that, where they know that there's a drop in income coming, and they want to just utilize their credits up front, so to speak.
Yeah, right? It's a very common strategy we see where people want to borrow money to buy shares, do things like a margin loan. It's always on offer, but the loan amounts aren't as high as buying property. Yeah.
Correct. Do depreciation benefits apply to property bought under SMSF as well?
Yeah, so when it comes to depreciation, so there's a tax depreciation schedule that's prepared by a quantity surveyor. And essentially what it is the ATO recognises that the fixtures and fittings within the property are going to depreciate or go down in price over time. They allow you to claim that back in your tax return via depreciation schedule. So it doesn't matter who you own it through. You will get that depreciation if you claim it and if you do everything properly. And it all depends on when you bought the asset. Is it first hand, second hand? Did you develop it yourself? How much can you claim? Getting that depreciation schedule is quite important. Make sure it's done correctly. But I think the most important thing to remember when you're applying a depreciation to a situation is what's your tax rate. And when I say that, if you're on the highest marginal tax rate, 47%, and you're able to claim back $10,000 in depreciation, then you can get back up to $4,700 in tax. If it's in your super fund, you're in an accumulation phase, well, you can get back 15% tax. So on $10,000, $1,500. If you're in pension phase, you got 0% tax. Therefore, you get back nothing. And if, let's say, for example, you're retiree, you own an asset, it's got depreciation on it, you can claim the depreciation back. But if you've got no income, you get no benefit from it. So there's no tax that you can pay back. So you've got to pay the tax in order to get it back via depreciation schedule. So that's probably the most important thing to remember. But to answer your question, yes, it does apply to super fund.
I think the next question was part of the previous question, which we've already answered, which was, if the prepaying interest is a short-term strategy, then, why would I use it? And if it can't just be replicated anyways. So I think we've already answered that. Yeah.
Yeah. Well, the perfect example, for instance, you might have someone that sells a property, makes $500,000 on it, 50% capital gains tax discount, $250,000 goes on to their assessable income. They're automatically in the highest marginal tax rate, 47%. But if they make $50,000 a year, well, then their tax bill, they're normally only taxed at 19%. So they don't mind prepaying it because they don't need to claim it next year because they don't have a very high tax bill. Whereas if they prepay the interest and they get a lot more money back in the financial year when they're paying the highest marginal tax rate. So it's really what's your specific circumstances for that financial year. And that's why a lot of people, if they're selling a big asset, they go, all right, Stefan, what options do we have for this year? Because how
can we claim back as much as possible? Yeah, exactly.
Yeah.
Okay. Another specific scenario has just popped up. Hope you can guide me. I have an established SMSF from 7 years ago. Since then, paid off a property, house worth 560K. Now, to buy a second property in the SMSF, I need to save up 30% in stamp duty. Other option is to sell this house and buy a commercial property up to 1.2 million. What would you suggest?
Can't make suggestions. When it comes to, we can give structuring advice when it comes to properties and what entities to buy it through. Can you afford it? In terms of building up the 30% cash, really matters about people's personal situations. So, how much money do I have? How much money can I afford to put into superannuation? Should I claim tax deductions on that contributions to super or not? And therefore, can we go and buy this new property and establish a loan for it? In terms of buying a commercial property, yeah, this is really, you got to speak to a buyer's advocate, a property professional, someone like Zavid to figure out how they properly structure it. But yeah, I can't tell you what property you should and should not buy. It's really up to your personal situation. And one thing we can't give advice on is direct property and what property to buy and to not buy. So, Maddie, I'm sorry, I can't give you more guidance there, my friend. I apologise.
Another one, and I'll start by saying no question is a silly question. If I renovate my property, can I claim that as an expense to save tax?
No, not a silly question at all. If it's a capital expense, it's very, very important for these situations to talk to your tax accountant because they're the ones that are generally responsible for lodging your tax returns. It all depends on if you want to claim depreciation on the asset. Generally, it will go towards either the capital value or if it's maintenance, it will come off the income. So it's really important to talk to your tax accountant about this question to figure out how it is considered, whether it's adding to the capital value or just as a general running expense. Generally, renovations will count towards the capital amount, and therefore you claim depreciation on it. So if you want to claim depreciation, then it's generally got to go towards the capital of it. Therefore, the cost base of it increases. But something to talk to your accountant about because they're the specialists when it comes to these kind of items.
Sure. Is there any other question anyone would like to ask? Silence.
Good session.
Yeah,
Been some really good questions.
Just before everyone leaves, I'll just say one thing. Thanks a lot, Steph, for this. For those who don't know, Steph's moved house just before the lockdown happened. He's still in the process of moving his stuff around. That's why his internet at home isn't working yet. And that's why he's taken time out to come to his office just for this session and spend some time with us. So thanks a lot for Steph. Really appreciate it.
No, really appreciate you having me here. Yeah, been a great session. Some awesome questions. If you've got any other questions, guys, feel free to email me. You can jump onto angeladvisory.com.au, click contact us on the website. And yeah, get in touch with us if you have any more questions or if you want to get some specific advice. So Vid, you're a good man.
Maddie's just shot through a parting question as well. So we'll just take that last one. Can you claim travel expenses for property visit or renovation under SMSF?
When you say claim it, yeah, again, this is a question for the accountant, how it gets treated at the tax time within your tax return. That's more a question for the tax accountant or the SMSF administrator, not something that I can answer. So sorry, Maddie, wish I could help you there, but unfortunately, I've got to stay in my lane.
Very important. Madhav's just asked a question as well. Can you please talk more about the services you provide? I believe it's for you, not for me. So go for it.
Yeah, if you want to find out more, just go to Angel Advisory. We've got a page called Services where we provide advice on superannuation when it comes to purchasing properties. We've got structuring. We do a lot of share portfolios, superannuation, life insurances. But generally, like a lot of our clients come to us where they've got a big tax event, where they might be earning really good incomes, they've got a lot of free cash flow, or when they're just really busy, they don't really know what to do next. Or they might sell a business or an asset and say, all right, where to next? And a lot of the big ticket items are when people are planning for their retirement, they're just not sure what steps to take when their income stops and they need to rely on their assets. But Madhav, if you'd like to look at our services, jump online and you'll see it all there. Thanks for the question.
Cool. I think that's it. Once again, thanks a lot for your time, Steph. And thank you everyone for being here. And yeah.
So Vid, thanks so much. Everyone else, thank you so much. So me, if you want to reach out to me individually, I can answer that questions. But thank you so much all for coming in. I really appreciate it, Vid. You're a great man.
Thank you. Thanks, guys. Have a lovely evening and stay safe, everyone.
Thanks a lot. Bye.
All right, bye.